Okay, well, good afternoon or good morning, everyone. I apologize for the late start here. Had some technical difficulties, so I apologize for that. But I am now here and still without a camera, but at least we're here and you hopefully can see my screen and hear my voice. Welcome to the Trading Coaches Playbook. My name is Brandon Wendell, as it says on the screen. And we'll go ahead and get started. Basically, I'm going to talk a little bit about, protecting portfolios and some of the options that you have, or choices, I should say. One of those is options, but others are not. But we'll talk a little bit about protecting portfolios when we have market volatility and things that we can do. So before we get started, just to remind everyone that we are not broker-dealers or investment advisors. So we're going to look at this information from an educational standpoint only, not telling you to buy or holding particular securities and giving you personalized recommendations about the markets. All markets do involve risk of loss. It's always a situation. No matter what we do, we can never eliminate that. We can just try to minimize the risk. And we're not subject to trading restrictions. So we can have a position in a security or initiate one at a time. And that being said, welcome. And I stay pretty busy. You see, we've got a lot of things going on with premium online workshops. We also have a lot of the free ones with the Trading Coaches Playbook every Friday, Power Hour every Monday, lots of good free information there. And it's also available on our YouTube channel as well. And I am pretty busy myself in the E-mini think tank. Monday, Wednesdays, and Thursdays, we look at the futures markets live, trying to find some opportunities. And just seeing some of the strategies that I teach. Like I said, I share my strategies and then kind of use those in the live markets 3 days a week. So it's kind of a cool opportunity. So bear with me for a moment. Okay, just returning a message here. Anyway, like I said, we're going to go ahead and kind of take a look at the markets and some of the volatility that's going on right now. Again, if I go into my Partner Center here for Wealth Builders HQ. I actually have quite a few programs I'm in charge of, but the main one is the E-mini think tank, as I was saying. And if you're interested in more of the strategies that I use, you can join us. There's two different types of subscriptions. One is a month to month and the other is quarterly. The nice thing about the quarterly subscription is we let you try it out. We give you a 2-week free trial with no risk. Basically, it's absolutely free for 2 weeks and you get full access to everything. So if you want to kind of kick the tires and see what we're all about, you can definitely do that. You can just click the link that Lee put up there for you. And you see there's recordings of the classes themselves. And basically, there's bonus videos right here that have educational material on how I trade, trading routine, finding zones, finding the right targets. And there's documentation that also goes along with that to help you with honing your skills to be successful in the markets. That's the main goal, basically. And, taking a look, actually, I want to switch here to that, taking a look at what's going on right now in the ES. We're actually a little bit bullish this morning, but we'll see how long that's going to last. Really, what's been going on with these markets, we've been getting a lot of volatility. And obviously, when there's volatility, people get nervous. Basically, I track quite a few things, but one in particular is the broad markets. And when I say that, I'm talking about the broad equity markets. And I am a futures trader, so I follow the S&P futures, NASDAQ, Dow, and Russell. And I do what's called follow the leader. So recently, we've had kind of a rally from October 27th on these markets. If I go back over to the ES and go to a daily chart, actually, let's go to a continuous. There we go. And like I said, on a daily chart, you can see we bottomed out right there around the 27th of October, started to rally. We actually started declining from, I'll call it this high right here, August 1st was our big decline. And now, again, we're at a point of inflection. Really, we're at what we call supply and trying to figure out, are we going to continue to go down and continue this downward trend we've been in, or is this breakout we've been experiencing for real and the end of the downward trend? You can see that we have kind of a downward trend line here. And I think, it didn't really accelerate. You need 3 touches for it to be officially a trend line. And we do have 3 right there. So technically, we're still in this bearish trend and testing this overhead sell zone or supply. We don't really have enough momentum to get through there yet. So we'll see. But, as I was saying, I would like to follow the leader, and the ES is not always the leading index. You take a look at the NASDAQ, again, the 26th, 27th, we rallied. August 1st. Nope, actually, this was July 19th was the high. Yeah, we actually made a higher high in the ES before the NASDAQ dropped first. And if we take a look at the Russell, pretty much the same picture. August 1st, we dropped, and the 27th of October, we started to rally. So as I was saying, when I look at these four, I want to follow the leading market to let me know, who's in charge and which way are we likely to go. So looking at right now, all four of them together, got that trend line there. Remove that for a moment. You can see the NASDAQ is showing strength. It is the leader currently to the upside. Not always, but as of right now, that's what it is. And again, going back to that August high, where were we? There it is, August 1st. You can see that the Russell was leading us down. And yeah, for the most part, the NASDAQ was still showing strength. So if we want to know right now, we're in an upward move. If we want to know if this upward move is likely to continue, we should really focus on the leading market. And that leading market is the NASDAQ, as I said. So going back over to my chart for the NASDAQ, I'll use this specific contract for a little more detail. And you see we actually bounced off of some projections earlier. We are actually trying to break above supply right now. And by the looks of it, we have enough momentum to continue this move upwards. As you can see today, we're at new highs. So really this zone has been broken. And there really isn't much as far as a supply zone here. We spent quite a bit of time in this area. This is a daily chart. So we have 1, 2, 3, 4, 5, 6, 7, 7 and well, 8 candles really that we spent there. So I can't imagine that this is going to be the supply that would hold us down. That being said, we also have plenty of momentum to be able to keep going. So it looks as though, as of right now, the NASDAQ and the broad markets may continue to rise up towards 16,000. So if that's the case, obviously we don't necessarily need any kind of a hedge, but if the markets do start to find that weakness and the Russell drags everything back down, you want to know, how can you protect yourself? Now, as a day trader, it's real easy. You just go ahead and switch direction you're trading, but not everybody is day trading. A lot of us have 401ks or IRAs, other portfolios that are not as easy to get in or out of, and we want to protect those. Well, you can do that using something called a hedge. So a hedge, it's very simple. Oops. A hedge is nothing more than using a security to offset risk in another. There's quite a few different securities that we could use for hedges. The most common one is options. A lot of people just buy puts and use that as a protective hedge or insurance for their portfolio or for individual securities. The problem with doing it on individual securities is it can become very expensive. You have to pay for those options, right? You're paying a premium. Well, there are ways to reduce that premium. We can do things such as what's called a collar. Oops, if I can spell correctly. We can also use vertical spreads. And we can even use options on indexes instead of options on the individual securities. And that's what we'll talk a little bit about today. The other thing we can also use are futures, because futures offer you an opportunity to trade the broad index. And if the index is going down, we can sell those futures and profit from a downward move in the underlying security, the futures index. Or we could even do a kind of a combination of the both. We could do options on futures. Now that becomes a little more complicated because there are certain steps you have to take. And really, whatever you're trying to hedge, you have to understand a couple things. First of all, you want to make as much money in your hedge as what you are losing in the portfolio you're trying to protect. Now, it doesn't necessarily have to be one-to-one. We can also allot for a little bit of a pullback and a little bit of loss before we start hedging as well, depending on how much we want to pay for the insurance and how expensive the insurance is. So a couple of main things that are going to kind of let us know Let's see. Actually, what I should do here is copy this. And let's see, do I have Word open? I do. I was working on another project. Got a lot of things going on right now. Anyway, there we go. So it's easier if I make notes there. All right. So basically, one of the things we have to look at is when we're deciding what kind of a hedge we actually want to use is how expensive is the insurance? Basically, the options. And one of the things that kind of dictates how expensive the options will be is volatility. Okay, when you have high volatility, that's expensive options. And if you have low volatility, then you have cheap options or cheaper. And that kind of comes down to a little bit of the timing as well, because when the markets are crashing or even moving down, not necessarily crashing, but moving down pretty fast, typically volatility will increase dramatically. And if you try to put on the hedge too late, once volatility has already risen, you're going to be paying a lot more for the insurance than if you had tried to put it on before the market started to drop. So, when people are saying, well, the markets are going up right now, so I don't really need to think about this insurance. Well, nobody really thinks about buying insurance, when the weather's great, but, if there's a hurricane bearing down on you, obviously you're not going to be able to get a policy, or if you do get a policy, it's going to be quite expensive. So same thing, we want to try to think about these things before the markets take a big drop and before we start losing money. If you take a look at a chart, and I'll just use, we'll do SPY as an example. That's the S&P index right here. Let me clean this chart up and bring in, let's see if we have implied volatility. Just want implied volatility. There's all these extra suites and stuff like that. I don't know what those are, so I just want to get a simple indicator. There we go. Let's try volatility, see what that looks like. I don't know if that's right. All right, I'm going to switch programs because I have others open, which is just as easy. There we go. And again, I'll look at SPY. And I could use any security, really doesn't matter. Oops, clean this up again. And under studies, there we go. Should have implied volatility. There it is, much easier. And we'll get rid of the RSI for right now because we're not using that as we speak. Perfect. There we go. So again, when you see markets dropping, you see how quickly volatility can go up. It doesn't always, the speed in which the markets drop have a lot to do with that as well. But typically, if we get a big drop in the markets, we'll go back to August here where the market started dropping. There it is. You can see as the markets are going down, volatility is already rising. So you're going to be paying a lot more for the options than you would have in the market environment where the markets were quiet and just moving sideways or even just increasing a little bit. And you can see that volatility doesn't always go up just when the markets are going down. Sometimes it can also increase. Well, it's not showing it here, but maybe a little bit. As we're moving up, volatility can jump as well. But typically volatility rises after the markets or as the markets are dropping. So when we're thinking about insurance, we want to kind of do it a little bit earlier. Now, the other thing you got to think about when it comes to your portfolio is what it is you're using as a hedge. Most people will try to look at the S&P 500 as a hedge. And that's because the S&P 500 kind of represents the overall market, the broad market. And you can use that as a gauge to how strong the market is going, either up or down. Now, you could use other securities or, maybe the NASDAQ, other indexes. But for the most part, the S&P 500 is a really common one because, again, it's, first of all, 500 securities are large cap, and it tends to kind of represent the U.S., well, not really the U.S. necessarily, but the global economy, although it is more U.S.-centric. Anyway, there's something else we have to keep in mind when we're trying to create a hedge. As I said before, we want to profit in our hedge, almost as much, if not the same, as what we are losing. And a measurement of movement is called delta. If you're an options trader, you're probably familiar with delta. Simply put, delta it's the amount of premium movement up or down based on a $1 move of an underlying security. Oops. Okay, and when you start looking at options, you'll actually see delta, and it's usually expressed as a percentage or really in a decimal for percentage. So basically, a delta of 1 would mean that, it moves 1 for 1, where if the market moves up by $1 or security moves up by $1, then the premium would move up or down by $1. So for instance, let me go, whoops, wrong one. I'm going to go to my toss here and go to trade. So if we take a look at, let's say, SPY index, let me clear this. There we go. And we'll just look at a random option. Doesn't really matter, but I have, there we go, Delta, Theta, Vega. Right now we're trading at about 437. So we see that the calls for 437, the call option, is currently trading with a delta of 0.51. A put actually has a negative delta, and that's because when the price of the security goes up, that premium goes down and vice versa. So negative deltas move opposite in value compared to the underlying security. Positive deltas move with. Let's put it this way. The options premium with the underlying security. Negative deltas, though, premiums move opposite of the price of the underlying security. I'm not going to bother typing it all out, but you get the idea. So when you buy a call, basically, you're trading the same direction as the underlying security. So you wouldn't necessarily use that as a hedge if you own a security and you're trying to protect it. But if you buy a put, as you can see, the puts have negative deltas and they move opposite directions. So this will gain in value. A 437 put would gain in value if the underlying security, the SPY, was actually dropping. Now, basically the delta can do multiple things. It's not just one thing. It is the amount of price movement that you'll expect. As I said, it's the amount of premium movement up or down based on a $1 move. So if the delta was, as I said, 0.51, that means that a $1 move in stock makes the option premium move only 51 cents. Okay, because again, it's expressed as kind of a percentage. So it's how much of that $1 movement you would get. So whatever price moves, you just simply multiply it by the delta, and that's how much your option premium should change, barring any other movement. Okay, we don't live in a vacuum, so it's not going to be perfect, but it gives you an idea overall of what to expect, right? So again, we would be buying puts because what we're trying to do, let's say we own a share of stock. One share of stock equals 1 delta. So basically, if you own 100 shares, you got it. That is 100 delta. So to be hedged, we need to balance that out. We need to be delta neutral hedging. And it won't always be perfect, but we try to get as close as possible to delta neutrality, which means if we have positive delta on the other side, we need negative 100 delta. So, and by the way, hedging is also dynamic. So not only are we delta neutral, but it's dynamic because deltas change. So we need to be a bit dynamic as well. I'm not going to go too much in depth with that because we do teach that with our options. I do some options trading as well with Wealth Builders HQ. I kind of keep it simple with my options trading. I don't do as much of the hedging, but I do what's called delta neutral strategies. And if you go back over to the programs here, you'll see, where is it? Go back a little bit. There we go. I have another program right here called SPX Cash Flow Secrets. And what I do there is use options, and I actually use what are called weekly options, although it's kind of mislabeled. They really should be called daily options now. But weeklies, and you'll see that here, there's weeklies. They expire pretty much every day. Well, if I go to SPX, they do. Again, I was on SPY, but there, SPX, we have Friday, Monday, Tuesday, Wednesday, Thursday, Friday, Monday the following week, and so on. So we have plenty of those options. Again, they're called weeklies, but they actually expire every single day. And what I do is I create what's called a delta neutral position, meaning it doesn't matter which direction prices move because I'm not affected. And I therefore try to profit from other things with the option rather than trying to profit on price movement. So you can actually profit from volatility changing. You can profit from time changing. And of course, you can always profit from the price movement. As I said, actually, I'm missing one column that I took out here. If I customize and bring it back, it's called gamma. I didn't really need it at the time, but just to talk about, again, the reason why that delta changes, gamma is an option Greek. All these option Greeks are risk measurements or risk attributes for options. That's all they are. They're just giving you a little bit of an idea of how to measure volatility, or sorry, not volatility, how to measure risk in your option strategy. So by choosing one of these options, let's say, for instance, again, I choose, let's make it simple by looking at a stock, say Apple. And right now, Apple is trading at $185. Okay, if we take a look at the 185 call, we see that we have a delta of 0.52, which again means that if Apple goes from $185 to $186, the option premium or value here would go up by 58 cents. That's the current delta. And you can see it's changing based on the gamma. Gamma is the rate of change of the options delta. And the delta, as we saw, is, well, again, it does three things. One is it tells you how much price of the option is going to go up or down based on a $1 move of the underlying security. Another thing that delta is, it's a hedge ratio. And that's where we're going to be looking at it, because it tells you, in a way, how much you need to be able to hedge a certain position. As I was saying, we want to be delta neutral. So if we have 100 delta, meaning we own 100 shares of stock, we need to be negative 100 delta for our position to profit just as much as we would be losing in the stock. So we're trying to go as delta neutral as possible, but because things do change, I mean, you saw how quickly they're changing right now. You see that delta is going 54, 56, 57, it's jumping all over the place. And stocks, it's moving up a little bit, not that much. And you can see how quickly that can change. So you do need to be a bit dynamic with your hedge. And then the last thing that delta can do, although it's not exact, okay, remember, delta can do one of three things. One is that amount of premium movement. Two is a hedge ratio. Number three, it's a percentage of the option expiring in the money. And I say it's not exact because it really isn't. It's just a kind of a guesstimate, if you will. So if an option has, as we saw, 0.6 delta, it means that it's got a 60% chance of expiring in the money. And that's why when we have options that are very close to the current price, you see them right around 50 or 0.5, because there's kind of a 50-50 chance of that option finishing either in the money or out of the money. Okay, as you go further away, and this may not be the best example. Again, I can go back to SPY, and probably not the ones that are expiring today, but going out a little bit further, again, you see these deltas in the first column. Right now, we're trading again at 438. There it is, 438. We're at 0.51 for the calls. And the further we go in the money, the higher the delta goes because they have a higher probability of continuing to stay in the money. The further out of the money you go, meaning the strike price of the option is above the current price, the lower that delta becomes. Puts are the opposite with a negative delta. At the money is 0.5. In the money goes higher. Out of the money, which is a lower strike, goes lower. That's it. So one of the problems that a lot of people do, they don't think about this. Let's say you owned Apple stock. Go back to that. Actually, let me do Tesla. I guess it doesn't really matter which security we pick. But let's say I want to protect myself. I own 100 shares of Tesla. Well, let's say I want to protect myself through the end of the year. So I use the January puts. So I go to my January puts. We're currently at $212. And the nearest put strike, I could either use 213 or 210. I'll use the 210. What that means is I'm allowing for about $2 plus of loss before I start protecting myself. The problem is if I buy one option, notice it's 0.43. Okay, so in my example, let's zoom in a little more so we can see this text better, hopefully. There we go. So if we have 100 shares of Tesla, that equals, as I said, 100 delta on the positive side. So I need to create negative 100 delta. Okay. Did I say the value moves up as the delta increases? What moves up is the amount of price movement in the premium you would receive if it's a call option. So again, if we're looking at 0.53 and the price is about 0.5, let's see. Yeah, again, this is only showing you one piece of the underlying, of the premium, right? Delta is only one piece of it. And as I said, as prices move, the deltas change due to gamma. But there are other things that are also influencing that premium. So just because we move a certain amount, it doesn't mean you're automatically going to get that 53-cent move in the premium. Because if volatility changes, the vega is going to influence that premium as well. And so will time to a certain extent. So yeah, it may, and again, when the prices move, if prices move up by one full dollar and the delta was 0.53, then you get a 53-cent move. But if you move up less, let's say you get a price move, and where's my calculator? There we are. Again, let's say we have 0.53 delta and the stock moved up by 33 cents. Well, you multiply that by the delta, and that's how much movement in premium you should expect. In that case, it'd be 17.5 cents. Okay. So it'd actually be about 17 cents. Again, there might be other influences though, volatility and others, and therefore it might not get that full movement. You know, options are a little dynamic. There's a lot more to it. I only have so much time to cover this with you right now. As I said before, if you want to learn more, you can join some of our programs that we have. For me, when it comes to options, I try to keep it simple. As I said, I only do, I missed it, the SPX and generating income on those weekly options on a regular basis. So what I'm looking at there are what are called vertical spreads, and combining some of those to generate income. So anyway, getting back to, again, hedging and protecting ourselves, if we're looking at 100 delta, that the positive side, we need to create negative 100 delta to hedge. Oops. So how do we do that? Well, again, if we buy a put at 210, notice the delta is only 0.44 on the negative side. So buy one 210 put. It was a January put, I should say that too. And that gives us a delta negative 0.44. Well, that's not enough, is it? So what we actually have to do is multiple puts. And if I did two puts, now we have a delta of negative 88, a little bit closer. Again, not perfectly hedged, but delta negative 88 versus, and you know, that's per share. Every option is 100 shares. So we just got to multiply that by 100. And our true delta now is negative 88, as I was saying. Well, again, it's not completely hedged, is it? We could add one more contract. The problem is that'll put us over the top. Basically, if I did 3, and that was what, 44. I'm gonna be lazy. I could do it in my head, I'm sure, but 0.44 times 3. Now we got 132, or negative 132 delta. Now that means, because again, we have a positive 100 versus negative 132, we actually make more if prices go down than we would be losing in our underlying security. So you have to kind of decide how much do you need. And there's nothing saying that we have to do the 210s. We could do a different hedge using different delta to try to get close. So if we wanted to, we could go down to the 205s, and instead of using, what do we got there, about 0.39, 0.39 times 3, and you can see that's 117 delta on the negative side. So it's a little bit closer. Or if we want to do just one option, well, we have to go much higher than this for the strike. Where are we? There's current price. And again, if I want to go right here, 1,290 put is a 0.98 delta. That's almost 1-to-1, but it's going to be much more expensive. Again, you got to keep an eye on your costs as well. So that's what I was saying. First of all, we got to figure out, okay, what do we need for a delta hedge? And again, this is doing the options on the underlying security. If you've got a whole portfolio, that's going to be kind of expensive, right? If let's say we got 5 or 6 different stocks, or maybe even a 401k with a couple of mutual funds, trying to do individual options on those is going to be nearly impossible or too expensive. So there's a couple of ways to lower the cost of that hedge. One is to do what's called a collar, which can also be a little tricky, but it's not too bad. Basically, a collar is buying a put and it'll be buying the put of the security that you're trying to protect, and at the same time selling a covered call. Basically, you're selling a call on that option, or sorry, on that stock as well. The price or premium that you receive for selling the call offsets the cost of the put. The drawback of this strategy is if you get a big rally in price, you could get your stock called away and you only get to participate in the upward move up to the strike price of the call. So that becomes a little bit of a problem. And again, it's reducing your cost. Okay. See, there was a 0.5 delta below the 0.44. Buying 2 of those would be 100. Sure, you could do that. Absolutely. You can mix deltas and choose different options, right? 0.5 versus a point, or, do 2 of these. But yeah, you could definitely mix and match to try to get the negative 100 delta. But we want to try to keep it as simple as possible. And here's the thing, if we go into something like a mutual fund, right? Let's say you own a mutual fund. Now, how do you hedge that thing? You can't really buy puts on a mutual fund, can you? But what you can do, as I said, is instead you can buy index options, or really not index options, but buy index puts to hedge. But there's now going to be another step that you have to deal with, because the mutual fund or stock is not the same. I can't type. As the index. They move at different paces, right? So we need to figure out how to measure apples versus oranges. How do we know how much of the index, the puts, do we need to buy in order to actually protect our portfolio? And therein comes another Greek called beta. Okay, beta is basically how your security moves versus the S&P 500. That's what beta is. And beta, again, is kind of like a percentage. And you can find beta on a lot of different websites. There's also tools, depending on which platform you're trading on, that will help you beta weight your portfolio, which is kind of neat. And that's what we need to do. We need to beta weight the portfolio. So we need to see, what is our portfolio? How much does it move versus the underlying index? And then we can actually truly protect ourselves and hedge ourselves properly. So for instance, let me see if I can find, usually I can go out to like Yahoo Finance as an example here. And like I said, you can use tons of different securities. It doesn't really matter. Let's see, top mutual funds. There we go. Actually, before I go there, let me go back one, or just do Tesla as a security. And as we look at this website, you'll see there's Tesla, information on the stock. And right here, it shows beta for the last 5 years on average monthly beta. Now, unfortunately, everything does change. So this is not exact science, but it gives you an idea. Right here, beta is 2.28. That means this is 228 times more volatile than the S&P 500. So if I were to try to use the S&P 500 to hedge 100 Tesla shares, I would actually need more because my delta technically is not 100. It'd be 100 times 228. Again, that's the percentage that I have of movement. So 228 times 100. And actually, I need about 22,800 on the negative side of delta to actually hedge my 100 shares of Tesla if I'm using the S&P 500 index. Yeah, this would be recorded. And as I said, basically, let me see if I can show, pull it off here. Hang on. YouTube. If you go to our YouTube channel for Wealth Builders HQ, you should be able to find in the playlist. Let me just make sure Wealth Builders HQ. Yep. There you go. So we have our channel, Wealth Builders HQ channel. And if you go into the videos, I'm not going to go through the whole thing right now, but if you go and look for the playlist, there should be Trading Coaches Corner, and the recording will be up. Not right away, but it'll be up there soon. Anyway, like I said, with the betas, we can actually go into markets, top mutual funds. Let's say we have a mutual fund, and it doesn't matter which one. I'm just going to pick one of these. Again, it's just random here. But let's say we had that mutual fund in our portfolio. Now we see that we have a beta for the mutual fund. So that tells us that we're actually only 13% more volatile than the S&P 500 by buying this particular mutual fund, if we have that in our account. And I don't know if I still have, let me see. I had, I'm definitely not gonna be able to find it right now. That's okay. I was gonna say I had a worksheet that I had created years ago for calculating beta weights of portfolios. So for instance, again, this is WWWFX, and oops, that's a security, the beta, and number of shares. So basically the beta of this is 1.13, as I said. And let's say you own, I don't know, let's say 240 shares of that. In order to beta weight, you need to actually multiply how many shares you have, because each share, again, is going to be a little bit more volatile than the broad market. So you have to do what's called beta weighting of your portfolio. And the neat thing is, as I said, a lot of programs actually have this built in already. And I'm not sure if it's where it is here now on TOS. Oh, there it is, beta weighting right there. And not only that, but I believe you can actually beta weight against other things than the S&P. So for instance, let's see, SPX, beta weighting. And right now I just have gold contracts. Obviously, I should probably put in some different stocks for this. But like I said, TradeStation has this. You have this here in Thinkorswim. There's a lot of different ways of doing this, but you can just simply beta weight your portfolio. Not sure what that button is. Oh, just some setup. Anyway, but it'll actually tell you how much you need in order to properly weigh against your portfolio. So like I was saying, if I go back here to my workshop or worksheet, let's see, equals C2 times B2. There we go. So my beta for that portfolio is actually 271.2, because again, I have 240 shares, but each share is slightly more volatile than the broad market. So if I were to go ahead and try to hedge this portfolio by trading SPX options, right? If I go out and let's say I want to protect myself until March of next year, well, I go find those options. And let's see, we've got March. Yeah, we can do the quarterlies. That's fine. Come on. Oops, I accidentally clicked it too many times, didn't I? There we go. And we don't need that many strikes. Keep it simple. Right now, we're trading at about 43.93 on the index. So 43.90 is the current at the money option. Again, you can see it's about 0.48 on the negative side to buy those puts. Perhaps we're okay with a little bit of a pullback. We don't necessarily need to hedge 100% right away. But if we were to have a bit of a pullback in the market, let's say, if we actually have a bear market or a market crash, that would basically entail the market pulling back from the highs, oops, wrong one, by 20%, right? Let me close this out right now for the volatility. And what were our recent highs on the index? Sorry, there's going to be a lot of notes there because this is from my SPX program. I got all my zones listed. But the high is 4607. That was the July high, 4607. Okay, so 4607. Let's say we're okay if it pulls back 10%, but if we go more than 10%, we want to protect ourselves, right? So 0.9. Basically, if we drop below 4150, we want to start protecting ourselves. So what I could do is go down to the 4150 and use those puts if I choose, or I could go ahead and use the current puts again, but not institute this hedge until we reach that certain price. But let's say we want to use the 4150. Where are you? Again, we wouldn't necessarily put a hedge on right now until it gets down to that area. But once it does, here we are, 4150 puts. We have a negative 25 delta, right? And I was saying that we need to have 271 delta. Well, we need to have that on the negative side, right? So what do we have here? 271.2. Not that that's necessarily important, but divided by 0.25. And I forgot to put the equals there. I did that wrong, didn't I? Trying to figure out how many we would need. Oh, it's not 0.25, it's 2.5. That's why. So we would need about 11 puts to properly hedge ourselves. Because basically, if we had 11 puts, again, the delta there is negative 0.25, although it wouldn't be that. It'd be more like 0.5 by the time we actually get there. But I'm just saying, if we did this hedge now where we're okay with it pulling back a little bit, we want to hedge ourselves using those particular puts. Well, we have a positive portfolio of 271.2 delta. So therefore, we need to have the negative delta equal that. And again, it'd be about 11. So if we did 11 puts times negative 2.5, I just did negative 11 times 2.5, that'd be 275 negative delta, and that would be a hedge. So if we had multiple securities in our portfolio, in order to properly beta weight the portfolio, basically we would have to keep doing this with every security that we have. So again, if I go back to another mutual fund, we'll pick some natural resource fund, FNARX. And let's say we own, 60 shares of that. And let's see the beta here, 106. These aren't too volatile. Let's see if we can find a more volatile index or a mutual fund. I don't know if there's any measurements of beta here anyway, but let's see. These are the most common ones. That's what it's giving me right now. Let me go further. Do I have another page? Yeah, we do. Next. There we go. Ow. Okay, come on. Mutual funds again. Why is it not giving me more results? I guess I just have to pick it off this page. That's fine. So let's say we're doing Cantor Fitzgerald appreciation. And this one, again, is not very volatile. FBPBX. And let's say we own 85 shares of that. Beta there, 1.06. And basically, all we need to do is copy the formula here. And then equals sum D2. I'll add one more to D5. And that'll be the beta that we need to offset. It's very simple to beta weight with these mutual funds. You just need to figure out how many shares you have and multiply by the beta. So let's say we have some European stocks here. And again, it's still not a huge beta. Surprise. But this one is TRZ PX. Beta of 1.12. Let's say we own 115 shares. There we go. So now we have a total beta for our portfolio. Again, you're just multiplying the number of shares by the beta to actually figure out what you need to offset. So we've got a 553 beta. We need to buy enough puts with negative beta to offset that. And if we're using a hedge right now at current price, we're what, 43.94, so basically 4,400 or thereabouts. If you're buying at the money or in the money, you can see we're at 0.49 or 0.5, and you just take enough of these to offset. But you got to make sure it makes sense to do this portfolio as well, because your cost could be quite high. You really don't want to spend too much on your insurance. So the alternative to doing this, again, if let me just kind of walk through this scenario, if you will. If we've got a point, let's call it 0.5, right? So in order to do that, our delta, say we do negative 0.5, if we do 10 of those, now we have a negative 500, almost, let's do 11. So we do 11 contracts or puts, and that gives us that negative 550 delta, right? It's pretty much offset, give or take. But the problem is that put is costing 125.70 on the index. Well, again, that's times 100. So we're looking at, what is that, 12,570? Oh, no, I'm sorry. Yeah, $12,570. Well, what's the total value of this portfolio? Well, I'm not going to go back and find the prices for each one of those mutual funds, but that's kind of expensive. So how do we offset the risk on that and reduce it? Well, one, instead of doing the SPX, we could do the ES options, which are options on futures. And by the way, the options on futures is something I discuss in the E-mini think tank. I actually had, let me see if I can find it. E-mini think tank. And we're going to be redoing a lot of those lessons as well. So you'll be able to catch up if you're interested in joining me for that. But if you go into bonus videos, I know there was one I did. There it is, options on futures. There's a whole session I did on that, and I'll be redoing it as well. But we'll talk more about that in some trading sessions coming up and in some lessons. Anyway, looking at the futures, you could see if I go to March, or even sticking with the old one, but really I need to go out. If I'm going out to March, I need the contract that expires then. I could buy puts. There it is, March expiration. And right now we're at 4,400 for the futures. There we are. And it's actually not that much less expensive to buy the options on the futures, as you can see. Sometimes it'll be much cheaper to do the options on the futures because you're basically getting leverage on leverage. So if I were to confirm and send that, actually, yeah, it is. Right now, it's only going to cost me $5,600 for that option versus $12,000. So my cost for that is half by doing the option on the future versus doing the option on the index. And now I'm able to hedge the entire portfolio with 4 different mutual funds with just one security. Makes it a lot easier. But like I was saying, if you know a little bit more about options, what I could also do is if I know where this is likely to go down to, and if you're in the E-mini think tank, you actually could look at the zones as well as trends. There it is. So by looking at the chart, there we go. And let's go, wrong one, out to the S&P. If we get a pullback in the equity markets, I can kind of estimate where we're likely to go down to by looking at my charts. And not only could I buy the protected puts, but to offset the cost of that insurance, perhaps I also sell an option and create this as a bear put spread that now has a lower cost basis for my insurance. So going back to trade, again, we do vertical now. I'm going to have to price this out myself, but I'm buying the 4,400 and selling. I don't know if we'll get much for the 3,900 right now, but again, it'll definitely reduce the cost. So there we go. Actually, it reduced it quite a bit. Instead of, what was it, $5,600, now it's only $3,900 to do the exact same insurance until March. Is that amazing? So again, it involves making sure that we have the right number of contracts using the beta weighting. Then once we know the beta of the security, or the portfolio, we can then identify the negative delta that we need. And by using the right securities, we can actually insure a portfolio with just a few steps, knowing how to do it right. So hopefully this wasn't too confusing and overwhelming for you. I didn't want to do that. I did go in a lot of different directions with this, but hopefully you enjoyed it. But no, actually one ES put contract is not going to be 11 puts. It's not going to be the exact same, no. So you will have to do more contracts as well. Sorry, it is going to cost more than that. My bad. I forgot to mention that. And I was off on the original guesstimate too. That was based on one, but no, one contract is one futures contract. And one futures contract is about the equivalent, yes, of the 100 shares of SPX. So it is similar. But no, I would probably have to do two of these puts rather than one to actually hedge properly. So we're looking at about $7,000 cost. It's still roughly a lot less than what we would if we're looking at the individual options on the SPY or even the index itself. Okay. Anyway, that's about my time. I've got to get going here because I got a bunch of things. I actually got to get ready for the SPX trade as well for cash flow, because I do that in about an hour. And I start to do my prep now. But if you want more information about this stuff, obviously you can watch the video again. It'll be up on our YouTube channel. You can also join me in the E-mini think tank. I'll be doing this as a lesson. With the E-mini think tank, we actually, as I said, get together 3 days a week. They're all recorded, so obviously you can go into the class recordings, but I also do lesson days, which are recorded as well and documented, supporting documents with it, as well as a Q&A session. So we do these live Q&A sessions every other month. So if there's any questions, that students can always get a hold of me. Not to mention, for my students, I'm always available as well. If you just scroll down, if you're a student, you log in and you can just send me a message so I get back to my students as soon as I possibly can that way. So it's kind of neat being in that interactive kind of mentorship type of program. That's really what I kind of created with the E-mini think tank. But I want to thank everybody for being here for the Trading Coaches Playbook. And hopefully I gave you a little bit of info on what you can do with the different choices for hedging portfolios. So again, thank you for being here. I apologize for the late start.